This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thank you for joining us. My name is Bruce Norris, and once again, we are joined by David Kittle, and we'll talk about mortgages and everything else involved in real estate. How do you evaluate the safety of the current pile of loans that are in place as opposed to any other time in mortgage history? Seems to me.
Yeah, we're making the best loans we've ever made right now. We came out of the crisis and it took a couple of years, but the loans are being scrutinized. They're being underwritten the way they're supposed to be. It's one of the reasons we have started Cypress Mortgage Capital, because it's a correspondent lending company. We're going to buy closed loans and we're going to do MSRs. We're going to service. We're going to get mortgage servicing rights because MSRs, the servicing side of it, is more valuable today because rates are lower. They won't run off. People are staying in their homes.
Okay.
So I think we're making the best loans ever right now.
Now, what you just said, that's interesting. So interest rates, I mean, I think this is an accurate statement. This is maybe a historic low, but it's certainly a low in the last, say, 100 years. So I think I'm going to go back to 1980 when we're funding loans at 17.5. And then for the next 40 years, there's a gradual decline in interest rates. And assuming that your portfolio is filled with a smattering of those loans for the whole duration, older loans were more profitable interest rate wise. And so for the last 40 years, we've had the luxury of anything that's in the portfolio probably pays more than today's loan. What happens when that chart reverses?
When interest rates are lower than when they're higher?
Well, right now, let's say now you've got the lowest ever. And I just interviewed Doug Duncan, chief economist of Fannie Mae, and he's going after, say, a prediction of 6% GDP growth in 2021. That's the top GDP growth in 50 years. And we had a 0.25% Fed fund rate. So I'm trying to say, what happens to the value of the mortgage portfolio if the mortgage rate goes to 4 or 5% and your portfolio's at 2 3/4?
Well, that's a real conundrum and a real delta there, isn't it? But nobody that has, this is my opinion, if you've refinanced to either pull cash out or to remodel your home, or you've purchased your home and you've got a 2 3/4 or a 3.5% rate and rates go to 6%, you're not moving.
No.
So the value of that 3.5% loan staying on the books for 12 years as compared to a 6% loan that may go up and may come back down and stay on there 5 or 6 years, I would argue that the longer term income is better for you.
Okay.
Because your return's better. It's a shorter return and more risk because that loan, if rates fall again after they go to 6 or 6.5, you're going to lose that anyway.
Okay.
But it's a delta and it's a conundrum to fight. And it's going to be an interesting MSR evaluation process if that hits and if Doug is correct.
It's interesting. I mean, in your entire lifetime of dealing with the loans, it's been almost the entirety of my career, interest rates have basically done nothing but go down other than in short chunks.
Correct.
So that's what we're used to. So it's just interesting to contemplate the other side. Now,
yeah, we're at 1950s interest rates right now, basically. Back, way before I got in the business, VA rates were down to 4, whatever they were. And I had never seen it when I originated this low. So you're right, they've fallen all the way down. I never thought that they would get as low as they are now. Never. I would have lost that bet.
We wrote a report in 2017 with the cover 2% mortgage rates and 40 trillion in debt. So unfortunately we got one and we're about probably to get to 50 or something on the other one. So anyway.
But you got to look at if that GDP hits that, then incomes will go up and the economy is just going to be steamrolling and interest rates have to go up at some point because every time, look, we don't have free markets. They're all manipulated markets. Right? The Fed's been manipulating rates for 13 to 15 years, holding rates down. So when you help one market, which is homes, real estate, mortgage business, you're killing somebody else. And we've been killing fixed incomes for 15 years. People on
Right.
Social Security and everything else, they've got no increase and no return. People on fixed investments, they've gotten smashed in this. So you help one artificially, you hurt somebody else.
Okay. So do you think that that's going to be a change in that cycle long term, or is that hard to say?
I think so if you want me to give you an answer, I'll give you my best guess, my educated guess. And certainly Doug Duncan is better than that, than I am. But if rates go back up, then it certainly will help people on Social Security and fixed incomes. But, I was always of the side that says as rates go up, people get off the fence.
That's
Surely,
right.
if
You're right.
this is going to happen, and Doug's correct, the refinance market will essentially be over, and you're going to go back to a purchase market. Therefore, if I could go on just a quick deep dive tangent, those people that have gotten in my business since the meltdown in 2008 have never seen high interest rates. They don't know how to sell, period. All they're selling is rate. And they know how to sell into a higher interest rate market. So it'd be very difficult for them. I think you'll see some companies close or be acquired if rates go up.
Well, especially if the refi, what percentage is the refi market of the loan business at this point? Is it 40 or 50%?
Oh, at least.
Yeah.
It has been. It's been a great market for all my friends that still own their mortgage companies. They've been printing money for the last year and a half, and good for them. They've been making tons of money on all these refis. But if they're not prepared for a purchase market, they're going to get hurt.
Can you take me through the journey of how the paper gets created and where it ends up? I don't understand that completely. So if I'm a mortgage broker and I create a loan, let's say if it's Fannie and Freddie, are they the buyers of that or the guarantors of that? What is their status in that?
If you're just a mortgage broker and you don't have your own warehouse lines, then you're selling those loans to an aggregator who's going to be on doing wholesale, like if it's Wells Fargo, who is also on the correspondent side. We're not, the model that we have down here is only correspondent lending, buying closed loans off people's warehouse lines. We're not on we don't have no plan to be at this point on a third party origination platform. But they're going to sell that loan. They get paid for the servicing rights. They get cut a check and they're out of it. Somebody else has bought that loan and they're going to sell it to Fannie or Freddie and retain the servicing rights to it and either service it or subservice it.
Fannie and Freddie are the people that hold the loan in that case for the duration?
Correct. Yeah, unless they've got, different private investors out there to do it. But yes, in most third-party originations, it's Fannie and Freddie. They're selling to an aggregator who's selling to the GSEs.
Now, where does the mortgage-backed security enter into the fray there?
Well, that would be Wells Fargo or an independent mortgage banker who had their own correspondent lending, who wants to do their own MBSs. And if you have the expertise and the skill to do that, then that's a really way to pair off your interest rate risk and to keep yourself competitive. So
when we first had the coronavirus hit, and I'm going to ask you a little bit about the market reaction to that, because I was really surprised. In 2019, for California, that's what I'm most familiar with, we had really the best set of charts that I'd ever seen. We had reasonably low inventory, no foreclosures to compete against, pretty boring sales and no price increases, with honestly the best set of charts. And then about April, May, all of a sudden it's off to the races. Our sales go up about 25%. Our prices go up 17.5%. And if I asked a crowd, okay, well, how certain are you of what's coming next in 2020? It would have been a very different answer than if I asked the question in 2019. And I realized, wow, urgency trumps certainty. And I didn't know that. I mean, to me, that was a real shocker that we could do that with all the uncertainty. So I just, the reason I brought that up is when we had the moratoriums on monthly payments, there was something about the servicers that they kind of got caught in the middle.
They did.
And
And thank you,
how,
President Biden has extended that. Okay.
and the
So,
middle is saying that you have to compensate the lender for what's not being paid you. Is that accurate?
yeah, if you're servicing the loan, that payment is due to the investor regardless of whether the borrower makes the payment or not. So there was a real fear among servicers or people who were subservicing. That was a cash crunch on its way. And, like I said before, when you are manipulating a market in any way, you're helping one and hurting somebody else. You can't help everybody in a market. Somebody gets affected negatively when you are pulling the string to help one portion of it. And that's
Okay.
what happened with low interest rates to the fixed incomes. And that's what we could have had a really bad warehouse line servicer crunch. And there were a lot of margin calls a year ago this time. And
Now, how did that get fixed?
cash, people borrowed against their mortgage servicing. Okay, they borrowed money to make their calls, and a lot of them originated their way out of it as rates fell and kept generating cash. But there were some people who didn't make their margin calls. It could have been a lot worse than it was. But I will say this: MBA, if they do nothing else, and they do a lot, but if they do nothing else, they advocate for their members better than anybody. And they went to the Hill and the lobbyists and the leadership at MBA and helped thwart that off and avert a real crisis. They did a great job.
When I owned the servicing rights, I mean, I thought that was sort of like a separate room, because the person that owns the mortgage, I thought, was in a different room. But kind of what you're saying is that maybe they own the mortgage, but I have the payment responsibility. I didn't know that could be carved out, but you're saying it is.
Well, look, you can make all kinds of decisions when you originate the loan. I can sell the loan, and even if I have warehouse lines, I don't have to service. And the three lending companies I had, I never had any MSRs. I didn't service any loans.
Okay.
But there are people out there right now. I have great friends that are mid-sized mortgage companies that are getting every loan on the books to service that they can because they believe they're valuable. Like I said earlier, you're going to stay on the books longer. But if you have, forbearance, and the borrower doesn't understand forbearance. I mean, most of them think, I just don't have to make my payments. It's no big deal. And then when forbearance is over, it's all due at once. It's not explained properly to them. But somebody still has to make that payment. So when the government says, it's okay, we're going to give you, because of COVID, you don't have to make your payments for whatever time period, the servicer still has to make the payments.
Okay.
And so somebody gets hurt in a manipulated market. Always.
Right. Right now we have 90-day lates, approximately, actually larger than 2008.
Yes.
What do you think the outcome of that is?
I think the outcome would scare me if I had a book of servicing right now. I'd be evaluating my servicing portfolio. Okay. Because people think who can still make their payments are just taking a break. Not a lot, but there are some out there. They're just saying, because they don't understand those payments are still going to be due at some point, and it's going to affect their credit. It's just the government saying, well, and I'm paraphrasing here, not exact verbiage, but we're going to extend forbearance and you can file it up until June of this year, just to give you a little bit more. Okay, that's great. Explain to them what forbearance is, and they're not doing a good job of it. And with people that are 90 days late right now, as that increases, if you're servicing loans, that would really bother me. That's a problem on the horizon.
Is that because people are making the incorrect assumption that when the forbearance ends, that the banks are just going to be, hey, we'll tack it to the end?
Yes.
Keep right on going.
Like I said, that's a great, a better explanation than actually what I did. And that's exactly what they're doing. They think it's going to be tacked onto the end. It's not. It's due. Those payments are due.
Is it the lender's decision just to say, okay, we'll put them on the back end?
No, that's in security, and I'm going to be a little bit of a guess on that, but because it's in a mortgage-backed security, no, that those payments are still due.
I didn't realize that could become an issue. I really thought it would be especially because of the aggressive foreclosures, prices got hit pretty hard in 2008 and 9 because it was the dominant inventory for sale. I thought we'd probably intentionally pass on that solution. So I
think of
didn't
all the
know.
decisions that have made, all the bad decisions that have been made during this virus. Shutting the economy down. What does the CDC say? Mixed messages out there, depending on which doctor you listen to. Each state, California making horrible decisions, in my opinion. Florida keeping everything open, their economy's still going. You have to look at your servicing portfolio and geographically, where are the loans that you're servicing? Where are they? And you have to look at them in that perspective as well. And it's
Okay.
a real evaluation.
Well, it's interesting what you just said, because there's a lot of sensitive people these days. I had a presentation I did in San Diego. And basically what I said, the gist of what I said is California and Florida handling the coronavirus very differently. I said, this morning I went out, I live in Florida now, so I went to work out at LA Fitness. There was no one there that wore a mask, not even the people that were the personal trainers working one-on-one with people. I have people that own gyms in California that you can't open the doors. So that's what basically that in a nutshell is what I said. I got a 20-page email negative response for that comment.
Did you really?
So, yeah. And this was from somebody that formerly liked me. He says, I used to really respect you. Now I think you're an a-hole. And went on to tell me,
Wow.
yeah, I crossed a couple of different lines. I also, somebody asked me, why I like Florida. And I said, well, one of the reasons I like Florida is because I feel like I understand the rules of engagement. I feel like sometimes the rules in California can get changed without my permission or without me knowing it's coming.
So
And
I
that
would
makes-
frame that a different way. In California, the government's going to tell you what and when, and they can change at any time. And you have your choice in Florida to live your life the way you want to. And that's the actual divide in our country right there, right? That's it.
Yeah. Yeah.
David, can I have a question? I have a question. So you said part of the reason that you started the new company was because of the MSRs, and that the refi, it's going to be pretty much gone, right?
Right.
So
If Doug Duncan is correct and rates rise, there's not going to be any loans to refinance.
okay, so the new purchase, inventory being what it is, where are you expecting all the new purchase, mortgages to come from?
Okay, so prices are up, and prices are going to skyrocket even more because the biggest, I shouldn't say the biggest, one of the top three problems. I have a really good friend in the biggest business, Phil Bracken, very smart man, great friend. And he's been harping on this for the last 3.5 years, and he's right. We have an inventory problem of affordable housing. All right. It used to be when I got in the business, I used to call it the move-up market. You buy your nice little house, live in it for a couple of years, it appreciates. You move up, wife wants a bigger kitchen, live there a few years, and finally get, your second or third move, you get your dream home. People moved up. Nobody that is just getting out of college right now can go out and afford a $300,000 house.
Well, where is that $300,000 house in California?
Well, it's not in California, but I'm saying, I'm going from the Midwest, there is, but they can't afford that. But you can't find that in California. Therefore, with rates going up even higher and no inventory, and I hate the term perfect storm, but it's going to be an imperfect storm for our business because there is no affordable housing out there right now.
Right. Well, what's affordable about housing is the interest rate. And so I'll circle back around. That's how you get somebody in. If the down payment isn't the issue, the monthly payment at say 2.75% interest, it is on sale.
Well, the down
It's not
payment is the issue for the young couple that's just coming out of college and they're having to pay back their student loans and they don't
Right.
have cash. That is the problem.
Right. But I mean, I think that's within, well, wouldn't that be a better policy than giving somebody a $15,000 tax credit? I mean, yeah.
Zero down. That's back to the discussion we started with. So I agree with you. As long as it's underwritten properly and they have residual income, then let's get them in the house. Yeah.
Okay. This is more an economist question, but it does have to do with interest rates. The interview with Duncan actually made me think, because I always thought all this money that we're throwing into the economy kept on getting us to zero, not to six. I always thought we were trying to make up for what didn't happen and we were breaking even. So I thought we were trying to prevent deflation, honestly. And when I saw those numbers, and what really struck me was they usually have a 3-year projection. So if I went backwards and I looked at the projection, so in January of 2019, they had projected for 2021, 2% GDP growth. And the same in January 2020, predicted 2021 would have 2% GDP growth. And then now they're looking at a 6.6% GDP growth. And so I just thought, wow, okay, we're not trying to break even. We're now off to the races. And that's really surprised me, because I thought, and this is what I want to ask you, the things that are in place that could be deflationary, to me, seem like they're growing in momentum. People that are over 65 are growing as a percentage of the population and not part of the workforce. That's inherently deflationary, I think. When you make progression in robotics or artificial intelligence, that's kind of the same way. It's naturally deflationary. So I'm still having a little struggle thinking how we're going to create really high inflation, but okay, that's a different problem than I thought we were going to be tackling.
I think that, I don't know whether that's tied directly to housing. And let me give you one tangent why I think that. If everything you just said is true in housing right now, if what we just said a minute ago about it is true, then they are totally separate, in that it's inflationary in housing right now with interest rates going up, and because the fact there's no inventory.
Right.
So if less on the market, the price of that house. Look, my neighbors in Louisville put their house on the market. They moved last week. He got relocated to Minneapolis. Hated to see him go. Great friends. They put their house on the market 3 weeks ago. The day after they put on the market, they had 10 showings, and they sold it for almost 10,000 more than they had it listed for, same day.
Yes.
Because there's no inventory.
Yeah. Well, that's an interesting thing too, because in California, typically right now, we would be building at a peak market 150,000 new homes, and we're building 60. And we've been building 60 or 50 for the last 8 years, when the cycle normally would grow. So those homes never got to be part of the existing home base. So when you have demand of 500,000 units, it used to be made up of 150,000 new homes.
Correct.
Well, it's not. So that 90 extra thousand lands on the existing inventory, and half of those people say, hey, I got a 2% mortgage rate, man, I ain't going nowhere.
Right. Because I just got the 2%. I pulled my cash out and remodeled it. My wife has a new kitchen. We put in a pool. We're staying.
Yeah, you're staying. That's right. Why not? Okay. Well, that's a really interesting thing. You know, we're constructing homes in Florida, and I can tell you that one of the big challenges for inflation, if you will, is, okay, can we get a piece of lumber? Can we get an appliance? So I understand too much money chasing something that's scarcity, because the price goes up. That's in fact what occurs. So yes, that's really interesting. Well, here's getting back right at the beginning. See, I think there's a window of opportunity before interest rates go up. You want affordable housing? We have it for free. It's called interest rate at 2. If we get as many people as we can legitimately qualified with a VA loan process, we'll have done them in America, I think, a big favor. And if we miss this, what we're going to do is try to subsidize it with dollars rather than a program.
Well, that's always Congress and government's response, is to subsidize everything with money. I mean, you know, the argument right now is the $1.9 trillion surplus, which is 70% pork that has nothing to do with COVID. And they're not even looking at the 900 billion of the previous stimulus they haven't even spent yet.
Yes.
So the term printing money this time is absolutely fact. They're spending so much money right now because of this, and bailing out every city that didn't manage themselves right, giving it to post offices, and it's driving up the cost of everything. You know, is it going to affect me? I don't know. I'm going to be 65 years old next month, to your point, right? I'm going to be one of those people you just mentioned. And it's my kids and grandkids that
Yeah,
are going to end up paying for this.
that's right. Do you pay attention to a gentleman named Ray Dalio?
I know the name, but no, sir.
Okay, he's written some interesting things. He's a very smart man. I'm going to try and interview him. I don't even know if I'm intelligent enough to ask him questions, to be honest with you, in what he knows. What he's done is basically, like I've studied cycles that have existed in my lifetime. He's studied cycles going back 500 years about how countries lose their status, like the dollar, the reserve currency status. So he went back all the way to Dutch and all of that. And unfortunately, we're following some patterns that are scary. And so that's one of those things that it's over my pay grade to try and even barely comprehend. But
It's probably over mine too, Bruce, but I hear what
Yeah.
you're saying, and I wouldn't argue at all the premise. I mean, you can't keep doing this forever. You just can't.
yeah,
David,
that's
being in the industry as long as you have, what is your take on technology in the
You have
mortgage industry?
I have this
Specifically.
discussion all the time. You have to have it. It's a must, but you can't get away from relationships in any business. And I go back to that, and I know all my friends in the business, including my kids, are so sick of me saying it, but people do business with people they like and trust. This is now and always will be a relationship business. My father's words to me in 1978 when I got in the business. All right. Here's how I'm going to answer that quickly. When I was a loan officer 6 years to the day when I started, I didn't have a fax machine. I didn't have my own underwriter. I had to take everything to FHA and VA to be underwritten. I had to hand carry my verifications. I waited 3 weeks for an appraisal, 2 weeks to get a credit report typed. Now that sounds like every father. Well, when I was a boy, I walked 12 miles to school every day, which was, a lie.
In the snow, uphill.
In the snow. But we closed loans back then with minimal fraud, hand carrying everything in 30 days, funded them. With all the technology in the world right now, with an LOS out there, pick one that tells you and prompts you through everything. We used to have to disclose truth in lending by hand, by the way. Most loan officers today can't spell truth in lending and don't know what it means. Couldn't explain it if they wanted to. And I'm, lumping a bunch of them in, and they're not closing loans in 30 days. They're closing them in 45 or longer. Some of them are, but for the most part, the market, with all the technology in the world, we have more fraud than we've ever had, and we're taking longer to close loans. So technology is great as long as it's applied correctly, but you still have to have the relationship to get the business. And we're not doing it any faster or any better than we did 40 years ago. And that's a fact. And there'll be people who argue with me, but they won't win it.
I'm going to tell you a story that it's exactly what you just said about remaining a person that contacts people. I had a really interesting experience, when we were one of the people that were predicting the crash, and turned out to be right. We got invited to UBS to speak to the top 10 hedge funds at dinner, which was kind of funny. Bruce Norris gets to sit with the top 10 hedge funds. And the first question I asked them was actually truthful. I said, hedge funds, what do you guys do? I don't really know. And they had a good laugh about that, but I was being honest. I didn't really know. And I think that was probably smart for me to do. But the gentleman that had invited me there then took me around, because that was a pretty successful meeting. And we went to meet a gentleman named Julian Robertson. And he was the guy that created the Tiger Fund. And he was revered in Wall Street. But what I noticed when we got off the elevator to his office, Julian saw this gentleman. And it looked like he had seen his long lost son for the first time in 10 years. It was impressive. And he came and he hugged it. Now, this guy was a broker from USC, basically, but he was obviously more than that to this man. And so I interviewed him. I said, you didn't see this reaction, but I did. So let me tell you what I saw. And then in the next day or two, being in the area, that's all I heard was how great you were, hands-on you were. He said, yeah, he said, everybody else is texting. And he said, I meet belly to belly with 10 people a day. And I said, well, I can tell you what, they think you walk on water, man. That's,
that's the one thing everybody loves about you, Bruce, is your candor, standing up there and saying you'll tell people you don't know what you don't know. Okay, not everybody does that. And to that point, that's exactly right. What has this virus done? We're sitting here doing a radio interview, looking at each other on a Zoom call. People are tired of Zoom. You can't go to a conference. It's the
Yeah.
human touch that's hurt. We're not getting kids back in school. We're damaging our children by not doing that. And that's back to the relationship of the business. That's the greatest thing about the mortgage and the real estate and the home building business is the relationships you develop with people. And
Yeah.
people still want to sit down, I think, and do business face to face.
I think they do.
Maybe I'm just old school. I am, but
Yeah, well, thank God some of us still are. I will probably wrap up. I thank you so much for not only for you coming to our I Survived events constantly, but always recommending whoever happened to be the next person that was probably going to get invited. You always put in a good word, and so they always felt like it was okay to come.
I've been writing down names he's been dropping right now. I'm like, hey, David Kittle mentioned you. It'd be great for the show.
If you want a list, call me, man. If you can't get anybody to come, call me because I'm happy to come back. That's one of the greatest 3 evenings I've ever spent in my life.
Oh man, thank you. Well, at the end of those meetings, man, this is what I end up saying. I always ask everybody what's on their mind, and mine has not changed, but and I used to be so optimistic it was going to be true, is that I would like every elected official to not act like a Republican or a Democrat, but act like an American first. And man, I'm losing faith in that being a priority. And I used to be, I used to believe it was going to be true. And
well,
boy,
me too. I'm losing faith as well. And I'll just tell you that, and I've actually said this at your events before, but what we need now more than anything are people that you just described, which we don't have for the most part. I think people go to Congress with that intent and then lose it. Remember,
Yeah.
it's never about the money. It's always about the money. And there's too much money in politics, and we need term limits.
Yes.
Desperately.
Yeah. Why can't? Okay. Well, do we have to ask Congress to pass that, or is that something that we can grassroots?
You got to get it on a ballot, but their response is always, well, you control term limits by voting for us. And that's really not true, because it's always the one with the most money can run the best campaign. I mean, that's just how it is at the end of the day. It's a shame. We need to take the money out of it. They shouldn't be able to lobby after they leave, and they ought to have term limits.
I would go with you anywhere to do that, but whatever we have to do, man, I'm in.
Yeah.
I used to serve in a lot of nonprofit boards, and one of the healthiest things that we did was impose, 2-term limits, 3 years twice, and then turn it over.
That's right. And it should. You're exactly spot on.
Yeah. All right. Well, David, I've always enjoyed talking with you, especially enjoyed this conversation, and have a safe trip home.
Thank you, Bruce. I appreciate you asking me again. It's great to see you, and I always enjoy this time with you. So have a blessed day. Talk to you soon.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.